Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about risk management, the entire module B summary. It's part of CAIIB course. Now you can get a copy of this PDF in PDF format in the description box below. Now, if we talk about balance sheet, there are two sides of the balance sheet, liabilities and assets. Now, liabilities represent the source of fund. An asset is the use of those funds. So, what are the liabilities? Capital and reserves and borrowed funds. And what are the assets? Cash and bank balances, investment, and advances. Now, if you talk about the general principles, now liabilities are taken at book value. Assets, the lower of the book value or market value. Now, minimum capital should be adequate to absorb the maximum loss that is likely to occur. Now, this is the basic principle of risk management. It means others' money is treated as more sacrosanct. Thus, capital in a business is regarded as surrogate of the financial strength of the business. Now, what then is minimum capital? To know that, one needs to assess the loss that is likely to occur. This leads to the concept of risk weight. Now, as per Basel 1, which addressed mainly credit risk, it defined the components of capital. It assigned risk weights to different types of assets. It assigned credit conversion factors to off balance sheet items. It benchmarked minimum ratio of capital to risk weighted assets. Risk weight norms under Basel 1 were of a straitjacket nature. The Basel 2 Accord addresses the shortcoming by emphasizing on credit rating methodologies. Now, if we talk about Basel II, the major three principles on which the Basel II Accord lies is minimum capital requirement, which replaces existing one size fit all approach with several options for banks. Second pillar, supervisory review process. It provides guidelines for supervisors for effective implementation. Third pillar is market discipline, clamps disclosure norms about risk management practices. The revised accord provides incentives to banks to improve their risk management system. Now, if we talk about the components of capital, regulatory capital would consist of Tier 1, Tier 2, and Tier 3 capital. Now, Tier 1 capital is also called the core capital, which includes paid up capital, free reserves, and unallocated surplus, less specified deductions. Now, Tier 2 is also called supplemental capital, where subordinated debts of more than 5 years is kept, loan loss reserves, revaluation reserve, investment fluctuation reserve, and limited life preference shares. Now, Tier 3 capital consists of short term subordinate debt, which is greater than 2 years and less than 5 years, solely for meeting a proportion of market risk. Now, Tier 2 capital is restricted to 100% of Tier 1 capital. It cannot go more than Tier 1 capital. Long-term subordinated debt to be less than 50% of Tier 1 capital. Tier 3 to be less than 250% of Tier 1 capital assigned to market risk. That is, minimum of 28.5% of market risk must be covered by Tier 1. Now, Pillar 1 minimum capital requirements. The total capital ratio must not be lower than 8%. The scope of risk-weighted asset is expanded to include certain additional aspects of market risk, also operational risk. For the first time, operational risk is brought under the ambit of risk-weighted assets. Thus, the total risk-weighted asset is equal to risk-weighted assets for credit risk. Okay. Now, if we have to calculate the Pillar 1 capital for credit risk, there are three approaches. Let's first talk about the standard approach. Now, based on the rating of external credit assessment institutes, satisfying 7 requisite criteria and to be approved by national supervisor, a simplified standard approach is also put in place. Internal rating based approaches based on the bank's internal assessment of key risk parameters. as probability of default, loss given at default, exposure at default, and effective maturity, etc. Now, foundation approach and advanced approach, it is divided into two. Now, banks, however, cannot determine all the above four parameters. In foundation approach, banks estimate PD and supervisor decide the other parameters. In the advanced approach, banks have mere say in the parameters as well. Okay. Now, pillar 1 MCR for market risk, the risk of losses in on balance sheet and off balance sheet positions arising from the movement in market prices. Following market risk positions require capital charge, interest rate related instruments in trading book, equities in trading book, and forex open position. Now, capital for market risk, the minimum capital requirement comprises of two components: specific charge for each security, general market risk charge towards interest rate risk in the portfolio. Now, capital charge for interest rate related instruments, banks have to follow specific capital charge prescribed by RBI for interest rate related instruments as given on page of the textbook. These charges range from 0 to 9%. Now, capital for operational risk, there is a general perception that the operational risks are on the rising path. The downfall of banks attributed to operational risk, it is the loss of resulting from inadequate or failed internal processes, people and system, or from external event. Now, pillar 1 MCR, capital for operational risk, capital charge for operational risk is can be measured to three approaches: basic indicator approach, standardized approach, and advanced management approach. Now, in the basic indicator approach, the average over the 3 years for a fixed percentage uh, of positive annual gross income. Standardized approach, banks' activities are divided into 8 business lines such as corporate finance, retail banking, asset management. Each business line is assigned a factor, say beta, which determines the capital requirement for that business line. Average for 3 years gives capital for operational risk. Now, advanced management approach, here's bank's internal risk measurement system is used after due vetting by the supervisor. As a minimum 5-year observation period for internal loss, data is required by this method over a period of time. Okay. Now, prevention and control of operational risk, personal, work culture, organization structure, audit and internal control, system reviews, and revision. Now, these are the ways you can prevent operational risk. Pillar 2, the supervisory review process, transparency and objectivity. These are the hallmarks of the process. The twin objective is to ensure capital of banks, encouraging banks to develop and implement better risk management practices, internal capital adequacy assessment process, which is also called ICAP. Now, this is something which is important: internal capital adequacy assessment process. The supervisory duties are guided by four principles. Banks should have rigorous process to ensure adequate capital. Supervisors should review and evaluate risk management system and strategies and take appropriate action wherever warranted. Supervisors should expect banks to operate above the minimum regulatory capital levels to cover the uncertainties related to the system and bank specific uncertainties. Supervisors should intervene and take immediate remedial action whenever a bank capital is sliding below the minimum regulatory capital. Supervisory review process would invariably involve some amount of discretionary elements. Supervisors must therefore take care to carry out their obligation in transparent and accountable manner. Now, pillar 3 is market discipline, disclosure norms to enable the market to assess a bank's position. Market discipline contributes to a safe and sound banking environment. Disclosure under pillar 3 have been ensured not to conflict with those required under the accounting standards. Information given under pillar 3 to be consistent with that given in the audited statements, bank to give all information in one place. Disclosures to be on a semi-annual basis. However, critical information needs to be published on quarterly basis. So proprietary and confidential information need not be disclosed. However, the bank must draw attention to the information that has not been disclosed and must state the reason for non-disclosure. The bank must, however, part with more general information on that subject matter. Bank should have a formal disclosure policy approved by the board. Pillar 3 prescribes qualitative and quantitative disclosure in this regard. Now, asset classification and provisioning norms. Now, an account is considered non-performing when interest or installments remain unpaid for 90 days, income recognition for non-performing asset to be on the receipt basis and not on accrual basis. Asset to be classified as standard asset, substandard asset, doubtful asset, and loss asset. The first stage of NPA is substandard category. Progressive deterioration drags it through the next classification. Now, NPA causes twofold impact on profitability. First, asset ceases to earn interest, and secondly, provisions are able to be create against the NPA based upon the asset classification and value of security, if any. Now, depending upon the age of the NPA, the classification changes. With the passage of time, recovery probability diminishes and provisioning requirement goes up. A non-performing asset backed with no security moves from substandard category to loss category. Provisioning requirement for doubtful 3 category and for loss category are same, that is 100%. So profitability is a function of 6 variables: interest income, interest expense, fee based income, staff expense, trading income, other operating expenses. So maximizing the first 3 and minimizing the others would boost the profitability. So banks have to optimize the allocation of funds among securities, credit portfolios, forex, bullion positions to achieve best possible results in terms of profitability and capital adequacy. So fee based income areas may have to be reworked for the introduction of new products and phasing out of the old ones. So if you like this video, you can press the like button, subscribe to our channel, and share it on social media. Help us to spread education in this beautiful world. Thank you.